Welcome to Trading Nation. I'm Mike Santoli. One of Wall Street's biggest bulls says the market is, quote, at the point of maximum uncertainty, but it could turn into one of the best buying opportunities of the year. That is Julian Emanuel. He is BTIG's chief equity and derivative strategist. He joins us now by phone. Julian, good to talk to you. So what do you think, what does this moment of maximum uncertainty encapsulate right now? What are we so uncertain about?
Well, if you think about it, Mike, basically you had this huge sell-off at the end of last year and an equally huge and really historic rebound to the point where, you were a long way away from the bull-bear dividing line, which we think is the 200-day moving average at the end of December. Now you've rallied back, whether it's the S&P, the Dow, credit markets, a lot of things, right back to this 200-day moving average, to where both the bulls and the bears are sort of hesitant and perhaps a little bit confused as to where markets go. From our point of view, if you see weakness, because you could see weakness with all these event risks coming over the balance of the quarter, we would take that as a buying opportunity, and we actually think that this 200-day moving average movement is something that has also happened in the option space. We think you can express long views towards 3,000, our year-end price target, using options. But we do think any weakness is a buying opportunity here. And
that would be 3,000 on the S&P 500, which now sits around 2,700, of course. And you mentioned that, these events coming this quarter. So that obviously would be, do we get a U.S.-China trade deal? Number one, is there going to be another government shutdown, presumably? And then where does the Fed stand? So those events are out there. What do you think is actually priced into the market right now on a kind of fundamental basis and then in terms of these catalysts?
Well, there is an expectation that at some point most of these things will resolve themselves favorably. Yes, there is near-term risk in the government shutting down, but ultimately we do think, and that the market thinks there will be a deal. Same with China. But what the real concern is right now is both earnings and the economy. People have looked at this first quarter. They've looked at the polar vortex. They've looked at the first government shutdown. They've looked at the earnings season. And there's a thought that earnings for the full year could be as low as, 0 to 2% growth. And the economy could likewise take a bit of a dip. We think that's priced into markets. So to the extent that there's anything that's confirming the fact that the market isn't slowing, that the economy is not slowing the way people fear, that's where the upside comes in.
Does the setup in terms of bond yields, both with treasuries and globally, give you any pause on this idea that we're going to see confirmation that the underlying growth story is intact?
It definitely does. There's no question about the fact that I think most people are surprised by how low the 10-year yield has been trading. On the one hand, that's good for stocks because, the discount factor for stocks is less of a hurdle. On the other, it does reflect the growth fears. What we would say there is what's fascinating, since the Fed went easier in the beginning of January and then once again later on in January at the FOMC meeting, inflation expectations themselves have ratcheted higher. And what we've seen over the last year or two is the 10-year yield plays catch-up with those expectations. So to the extent that there's a floor under the 10-year yield and things do start to creep a little bit higher, that will be further confirmation that the weakness in both earnings and the economy is potentially over-discounted.
All right, and if you're seeing the S&P 500 getting up to around 3,000 by the end of the year, that's a double-digit gain, and obviously you're saying if we get a pullback from current levels, it should be bought. What types of stocks, maybe what sectors or styles of stocks would work in that scenario?
Sure. So we think part of this fourth quarter of last year was such that you really over-discounted again this potential for recession. And that sent the very deeply cyclical stocks, energy, industrials, financials, to what we perceive to be very healthy discounts. And if you look at it, those types of areas have outperformed since the market's bottom on December 26th, but they're still way, way off of their highs of last year, as opposed to the defensive names, which have not performed as well since the market bottom, but they're still near their highs. So we think there's more catch-up to be played for the more cyclical areas.
All right, so play offense, I guess, is the takeaway. Julian, thanks a lot for joining us today. Always good to talk to you.
Same. Thank you.
All right, and thank you for watching Trading Nation. I'm Mike Santoli. We'll see you next time.